Financial education. 8 personal finance lessons schools don't teach you. Among the many disciplines that you're taught at school, personal finance lessons or financial education are somehow never part of the list. For a host of reasons, lessons about money aren't deemed important enough to be part of the school curriculum. As a result, students end up missing out on some of the most important teachings in life and are prone to making ill-advised financial decisions as they transition into adulthood. So, what exactly are these lessons that school didn't teach you? These range from basic insights such as the importance of maintaining a budget and understanding investment to more complex ideas such as interpreting financial statements and appreciating good credit practices. Other key ideas include doing taxes, learning about the dangers of debt, and realizing the importance of having an emergency fund. Keep watching this video to find out more about these lessons. 1. Budgeting and why it's important. Budgeting is the cornerstone of basic personal finance. It's an idea that must be implanted in the minds of children at a very early age. The essence of having a budget is to make sure you live within your means and build wealth gradually, paving the way towards a financially secure future. Merely having a good budget plan isn't enough. Sticking to one is of paramount importance. Here's how a budget works. To get started, calculate your monthly income and your overall monthly expenses. These include utility bills, rent or mortgage payments, groceries, insurance expenses, etc. Subtracting the expenses from the income, the remaining amount can be allocated for personal expenses and leisure. In accordance with good financial practices, an amount must also be set aside for investment expenditures. 2. Investment and passive income. Investment is another key pillar of personal finance. If done properly with the necessary knowledge, it can yield profits and set you on the path towards financial security. Common types of investments include investing in commodities, stocks, bonds, and mutual funds. To invest successfully, you must learn to look out for good investments and steer clear of potentially bad ones. This skill requires time and experience. Passive income is any form of income that requires minimal effort on your part. Such sources require an initial investment of your time and/or money, but eventually you'll be making money even when you're asleep. Examples of passive income include rent, dividends from stocks, blogs, affiliate marketing, and royalties from books and other intellectual property. Developing streams of passive income plays a vital role in building wealth. 3. How taxes work. Although most of us weren't formally taught about taxes in school, we did have an inkling of what they were, but that wasn't sufficient. Students today must be taught what exactly taxes are and how to calculate them. Taxes are amounts paid from your income as revenue to the government. Each member of society must pay taxes as soon as they start working, and the amount deducted will be based on each individual's income. Taxes are usually calculated and paid once a year, so you have to monitor your spending and make sure you have the adequate amount when it's time to pay. You can be taxed on a number of different areas, depending on your lifestyle and where you live. The various types of taxes include income tax, property tax, sales tax, employment taxes, and excise tax. 4. Why creating an emergency fund is important. Having an emergency fund is crucially important to your financial well-being. It is a safety net that can save you from running out of cash suddenly and taking debt. Emergency funds are immensely useful in sudden, unexpected events, such as losing your job or losing insurance for an upcoming expenditure. A very good example of this is the COVID-19 pandemic, which saw many people being laid off from jobs and facing staggering medical expenses. To create an emergency fund, you must set aside a certain amount and make monthly contributions to it. These contributions can vary each month, owing to fluctuating expenses, but they mustn't stop. You can also invest your emergency fund money in low-risk options, such as savings bonds and checking accounts. You should have enough money in your fund to cover your living expenses for 2 to 6 months. 5. The perils of debt. Debt is an instrument that lets you purchase items instantly and pay for them later. Debt can also refer to borrowing an amount of money and returning it later. In both scenarios, you may be liable to pay an interest amount on top of the original amount. Although it is meant to facilitate purchases, debt can be harmful for a number of reasons. Here are a few of them. High interest rates mean you sometimes pay more than the amount of the purchase. Failing to pay on time on a frequent basis can throw you into a vicious debt cycle. You'll be taking new debt to pay off old debt. Debt payments can increase monthly expenses. Since your income is the same, you'll be forced to cut down on personal and leisure expenses. This can impact your mental health. 6. What are good credit practices? Credit is your ability to obtain items instantly and pay for them later. How easily you can get credit for a purchase depends on your credit score. Following good credit practices is essential for building a strong credit score, which in turn measures your ability to pay your dues on time. A strong credit score means lenders trust you more and are likely to help you make your purchase. What are good credit practices? These include taking out loans only if you can afford to pay them back and always paying them on time. Keeping your total expenditures well below your allowed credit limit is also good practice, as creditors take that into account too. 7. Interpreting financial statements. Interpreting financial statements is a really important skill that must be taught in schools. These statements can be your own personal bank statements, as well as the financial records of a particular company. Knowing how to interpret your bank statement allows you to keep track of your income and expenses, check interest rates, dues or other fees, and spot any abnormal activity in your account. If you're thinking of investing in a particular company, knowing how to interpret the company's income statement, balance sheet, as well as other financial statements will help you decide whether or not investing in it is a good idea. 8. Buying or renting property. Buying or renting are the two options you have if you're preparing to move into your first house. Without the right financial knowledge and decisions, there's a big chance you'll make a decision that can negatively impact your financial health. Here are some insights to help you out. Whether you choose to buy a house or rent it, there are more expenses to be undertaken in the process than you might anticipate. These include property taxes, realtor fees, deposits and maintenance costs. If you're intending to mortgage a property, you'll need a good credit score as well as tax return documents and investment statements. You'll need to make a down payment as well as regular payments. Mortgage agreements will specify the duration of the loan and the rate of interest that you will be paying.